Okay, so good day. Again, this is Francis Kaliwan and welcome to another video on lessons in financial accounting and reporting. Our topic for today is accounting for income taxes, and our discussions are based on the provisions of IAS 12 income taxes. This standard was adopted by the International Accounting Standards Board in April 2001. The objective of IAS 12 is to prescribe the accounting treatment for income taxes. The principal issue actually in accounting for income taxes is the accounting for the current and future tax consequences of number one, the future recovery of the carrying amount of the asset or the future settlement of the carrying amount of the liability. Um, Reported in the statement of financial position. So basically, this talks about tax consequences, whether current or future, for the recovery or the settlement of the carrying amount of the assets or liabilities reported in the financial statements. Number two, this standard will also discuss the accounting for the current and future tax consequences of the transactions and other events of the current period that are recognized in the entity's financial statement. Okay, so so before we proceed, let us have these learning outcomes first. Number one, describe the fundamental principles of accounting for income taxes. So, what are the principles behind the accounting for income taxes? Distinguish between accounting profit, or what we call pre-tax profit, and taxable profit. Recognize current income tax arising from taxable profit. So later I will discuss the relationship between current income tax and taxable profit, and recognize deferred income tax arising from the temporary differences between the accounting profit and taxable profit. Present income tax expense, income tax assets and liabilities, and deferred tax assets and liabilities in the financial statements. And finally, identify the required disclosures related to income tax expense. Okay, so the first topic in our lesson about income taxes is the determination of the differences between accounting profit and taxable profit. So, as defined in IAS 12, accounting profit or loss is the profit or loss for a period before deducting tax expense. So, accounting profit is pre-tax profit computed based on the requirements of the accounting standards or the IFRS, and the definition, recognition, and measurement criteria in the conceptual framework. So we determine accounting profit by deducting the cost of sales and operating expenses from our revenue. Whereas taxable profit, as defined in IAS 12 also, so taxable profit or loss is the profit or loss for a period determined in accordance with the rules established by the taxation authorities, which is in case of the Philippines is the Bureau of Internal Revenue, upon which income taxes are payable or recoverable. So we determine taxable profit by deducting the allowable deductions from our taxable income. And if accounting profit has IFRS, taxable profit has National Internal Revenue Code or NIRC. Because accounting profit is derived based on the accounting principles and taxable income is derived based on the regulations of the tax code and taxing authorities, differences exist between accounting income and taxable income. Okay, so now let's discuss the types of differences that cause why accounting profit is different from taxable profit. So we have two: permanent differences and temporary differences. So permanent differences are revenues and expenses included in the computation of accounting profit but never in taxable profit. So permanent differences are items of revenues and expenses that are recorded for accounting purposes because maybe they meet or essentially they meet the recognition criteria in the conceptual framework and accounting standards, but they are never included in the computation of taxable profit because the revenue items are non-taxable or the expense items are non-deductible. Later, I will discuss what are non-taxable uh, revenue and non-deductible expense. Whereas temporary differences are the differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. So temporary differences occur when the carrying amount of the asset and the tax base of the asset are different, or the carrying amount of liability and the tax base of liability are different. Now let's discuss in details the types of permanent differences. So we have non-taxable revenues, which are defined as revenues that have been included in the determination of accounting profit but were not included in the determination of taxable profit. So examples of these revenues are income that were already subjected to final withholding tax. Example of these incomes are interest from bank deposits, winnings, or prizes. When we receive those incomes, they are already subjected to final withholding taxes. We also have intercorporate dividends, proceeds of life insurance settlement, and all other exclusions from gross income per our revenue code. Whereas non-deductible expenses are expenses deducted in the determination of accounting profit but were not allowed to be deducted in the determination of taxable profit. So examples of these expenses are the fines and penalties for violations of law, insurance premiums for life insurance of officers, where the corporation is the designated beneficiary, and all other expenses in excess of the limits for the deductions from the gross income that are allowed by NIRC. So basically, these types of revenues and expenses are discussed in details in your income tax course. Next is how do permanent differences affect our accounting profit? So let's have this illustration. So accounting profit or our pre-tax profit, from that item, we deduct our non-taxable revenue and we add our non-deductible expenses, we get our accounting profit subject to tax. So basically, we just omit the effects of non-taxable incomes and non-deductible expenses from our accounting profit to arrive in our accounting profit subject to tax. And that accounting profit subject to tax, if multiplied with the tax rate, will result to our income tax expense. And that income tax expense, if deducted from our accounting profit, will result to our profit or net income. So again, the accounting profit omit the effects of non-taxable income and non-taxable expenses, will get our accounting profit or accounting income subject to tax. That amount is multiplied by the tax rate, we get our income tax expense. And that income tax expense, if deducted from our pre-tax profit or accounting profit, we will get our net income or our profit for the period. To illustrate, let us have this example. The following information are extracted from the records of Ayala Corporation. So we have capital gains subjected to final withholding tax, 2 million. Fines and penalties for violations of environmental laws, 400,000. Charitable contributions in excess of tax limitations, 40,000. During the year, Ayala Corporation reported a pre-tax profit of 10 million. Income tax rate is 30% and the requirement is to determine the profit for the year. Okay, so to solve this problem, first is we identify whether the items of incomes and expenses enumerated are either permanent or temporary. So first, capital gain subjected to final withholding tax. So as the title of the item suggests, the income is already subjected to final withholding tax, so it is classified as non-taxable revenue. Next, fines and penalties for violations of environmental laws. So these will not be allowed by the NIRC to be deducted from our taxable income. So this is a permanent difference as well, classified as non-deductible expense. And charitable contributions in excess of the tax limitation. So excess of the limit of the charitable allowable deduction. So again, this is also a non-deductible expense. So we have a non-taxable revenue of 2 million and non-deductible expense of 440,000. So our solution is from our pre-tax profit of 10 million, we deduct our non-taxable income of 2 million. We add our non-deductible expenses of 440,000. We will arrive at our accounting profit subject to tax of 8,440,000. Our tax rate for the current year is 30%, and therefore our income tax expense is 2,532,000. And that 2,532,000, assuming there are no other differences. So the differences given in this problem are the only differences of the accounting profit and taxable profit. So this will already be our current tax expense. So since that is our current tax expense, that will be reported as our income tax payable. So our entry for the 2,532,000 is debit income tax expense and credit income tax payable. And to answer the requirement, we have pre-tax profit of 10 million less our income tax expense of 2,532,000. We will get our profit of 7,468,000. Okay, so now that we're through with permanent differences, let's discuss temporary differences. So from a balance sheet perspective, a temporary difference is the difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Whereas from an income statement perspective, a temporary difference occurs when a revenue or expense is included in the accounting profit in one period but reported for tax purposes in different periods. And same with permanent differences. Temporary differences have also two further classifications. So we have taxable temporary differences and deductible temporary differences. So let's discuss first the taxable temporary differences, or what we call future taxable amounts. So these are temporary differences that will result in taxable amounts in determining taxable profit or loss for future periods when the carrying amount of the asset or liability is recovered or settled. So technically, these differences will result to future taxable amount. And again, from a balance sheet perspective, when the carrying amount or carrying value of an asset exceeds its tax base, or when the carrying value of the liability is less than its tax base, the temporary difference is a taxable temporary difference. And from an income statement perspective, temporary differences result if the accounting income is higher than the taxable income. So in summary, let's have this carrying amount of an asset higher than its tax base, carrying amount of liability less than its tax base, and accounting income higher than its tax base. So this will result to future taxable amount. Next, deductible temporary differences or future deductible amounts are temporary differences that will result in amounts that are deductible in determining taxable profit or loss of future periods when the carrying amount of the asset or liability is recovered or settled. So from a balance sheet perspective, when the carrying value of an asset is less than its tax base, or when the carrying value of the liability exceeds its tax base, the temporary difference is deductible temporary difference. And from an income statement perspective, when an accounting profit is less than taxable profit, the temporary difference is deductible temporary difference. So again, in summary, carrying amount of an asset is less than its tax base. Carrying amount of liability is exceeds its tax base, and accounting income is less than taxable income. This will result to future deductible amount. So para mas madali itong maalala, always remember that asset and income are friends. So kapag future taxable amount, accounting income is higher than taxable income, since friend niya si asset, so carrying amount of asset also is higher than tax base of an asset. Tapos pag binaliktad mo na yung equation, it will result to future deductible amount. No? So kung ano ang nangyayari sa income, yun ang nangyayari sa asset para ma-maintain natin yung future taxable amount. At pag binaliktad mo, yun ang nagiging future deductible amount. Now, considering both the permanent differences and the temporary differences that we've just discussed, we can now reconcile the accounting profit with our taxable profit. So let us have this reconciliation. So first, we started with our accounting profit or pre-tax profit. We omit the effects of our non-taxable revenues and non-deductible expenses, and we arrived at our accounting profit subject to tax. And from that amount, we also omit the effects of the future taxable difference and future deductible difference. We will arrive at our taxable profit. So again, for our taxable temporary difference, since they will be taxable in the future, we less these amounts. And for deductible temporary difference, since they will be deductible only in the future, we add back these amounts. And again, we will arrive at our taxable profit. And kanina in our discussion, I've mentioned that accounting profit subject to tax, if multiplied with our tax rate, we will arrive at our income tax payable. But this time, because we already have future temporary differences, our new basis for the income tax payable is the taxable profit. Okay? So if our taxable profit, if multiplied with the tax rate, we will get our income tax payable. And again, our entry for that income tax payable is debit income tax expense and credit income tax payable. Now, how about the temporary differences? For our deductible temporary difference, if we multiply that with the tax rate, we will get our deferred tax asset. But notice that the tax rate which will be used in the determination of deferred tax asset is not the current tax rate, but the future enacted tax rate if there is any. Why? Because this amount, again, is deductible in the future. Therefore, the tax rate which will be used is the future enacted tax rate. Same story for taxable temporary difference. So the tax rate which will be used in the determination of deferred tax liability is the future enacted tax rate. So other than the tax rate, please also take note that the amounts that will be determined if we multiply the future temporary difference with the future enacted tax rates are the required balances of either the deferred tax asset and deferred tax liability. Meaning these are the amounts that will be presented in the statement of financial position, and these amounts will not be offset. So deferred tax liability is reported as separately as non-current liability, and deferred tax asset is reported separately as non-current asset. Whereas income tax payable, as always, is reported as current liability. Now, to summarize the three income taxes, let's have this discussion. So first, we have income tax payable, and the formula for our income tax payable is taxable profit times current tax rate. And the entry to record income tax payable is debit income tax expense current and credit income tax payable. And again, income tax payable is presented in the statement of financial position as current liability. Next, for our deferred tax liability, our formula is future taxable amount times future enacted tax rate. And our entry for the recording of deferred tax liability is debit income tax expense deferred and credit deferred tax liability. And deferred tax liability is presented in the statement of financial position as net current liability. And finally, for our deferred tax asset, the formula is future deductible amount times the future enacted tax rate, and the entry to record deferred tax asset is deferred tax asset debit and credit income tax expense deferred. And deferred tax asset is presented as non-current asset in the statement of financial position. And finally, to determine our total tax expense and our profit for the period, let us start with our income tax expense current, and then we add or deduct our net deferred income tax, the net of our income tax expense deferred arising from deferred tax liability, and income tax expense or benefit deferred arising from our deferred tax asset, and we will get our total income tax expense. And this total income tax expense will be used in the determination of our profit. So pre-tax profit minus the total income tax expense, we will arrive at our profit or net income for the period. Okay, so now let us apply our discussion for deferred tax asset and deferred tax liability using this illustration. So the following information are extracted from the records of San Miguel Corporation for the year 2020. So the carrying values of the indicated assets and their tax bases are given. So we have accounts receivable, inventories, building and equipment, warranty liability, and unearned rent. San Miguel Corporation is subject to 30% income tax rate, and San Miguel believes that any deferred amount is fully recoverable. During the year, San Miguel reported a 5 million pre-tax income and made no income tax payments relating to the current year's operations. Requirement: prepare the entries for the year. To answer this problem, let us analyze first whether the differences in the carrying values of the assets and tax bases would result to future deductible amount or future taxable amount. So again, our formula is if the carrying amount of an asset exceeds its tax base or the carrying amount of liability is less than its tax base. And finally, if accounting income is higher than the taxable income, then that is a future taxable amount resulting to deferred tax liability. So, yun lang ang i-memorize mo. Pag binaliktad mo yung mga yun, of course, those are future deductible amount which will result to deferred tax asset. So, first, for accounts receivable, carrying value is 19, tax base is 21. So, the difference of 200,000 is future deductible amount. For inventory, carrying value is 950, tax base is 850. The 100,000 difference is future taxable amount. For building and equipment, carrying value is 10 million, tax base is 8.2 million, so higher sa carrying value. The difference of 1.8 million is future taxable. Warranty liability, carrying value is 800, tax base is nil or zero, so the 800,000 difference is future deductible. Same with unearned rent, 500,000 carrying value, tax base is zero, so another 500,000 future deductible. So in summary, we have these differences. So total future deductible amount is 1.5 million while future taxable amount is 1.9 million. Okay? Now, let's compute our taxable profit. So our accounting profit subject to tax is 5 million because we do not have any permanent differences. So our pre-tax profit is also our accounting profit subject to tax. And then we less our future taxable amounts of 1.9 million and we add our future deductible amounts of 1.5 million. Our taxable profit is 4.6 million. And from that amount, 4.6 million times our income tax rate of 30%, and then future deductible amounts of 1.5 million times our tax rate. There is no future enacted tax rate, so we will also use 30%. And then future taxable amount of 1.9 million times tax rate, we will get these taxes. So for our income tax payable, we have 1.38 million. For our deferred tax liability from our future taxable amounts, we have 570,000 and our deferred tax asset is 450,000. Now, question, how much is our total tax expense? So that is current tax expense of 1,380 plus deferred tax expense arising from DTL, which is 570, less deferred tax expense arising from deferred tax asset of 450,000. Our total tax expense is 1.5. We deduct 1.5 from our accounting profit subject to tax, which is 5 million. Our profit is 3.5 million. Okay? So what are our entries for our income tax payable, deferred tax liability, and deferred tax asset? We have for our income tax payable, debit income tax expense current 1.38 million, income tax payable 1.38 million as well. And then for our deferred tax asset, we have 450,000 debit and income tax expense deferred credit for 450,000. And for our deferred tax liability, debit income tax expense deferred 570,000 and deferred tax liability 570,000 as well. Now, assuming we change the information so that the deferred tax liability and deferred tax asset have beginning balances. So what will be the effects to our answer? So using the same information for San Miguel Corporation, but consider the following additional information. So the company's statement of financial position at December 31, 2019, so for previous year, showed deferred tax liability of 480,000 and deferred tax asset of 525,000. So for our deferred tax liability, our beginning balance is 480,000 but our ending balance based on our computations for the year 2020 is 570,000. So DTL increased by 90,000. Whereas for deferred tax asset, the beginning balance is 525,000 and the ending balance is 450,000, therefore a decrease of 75,000. Now, what will be our entries? For the deferred tax liability, since the account increased, so another income tax expense deferred for 90,000 and addition to deferred tax liability, only the 90,000 increase. So yun yung sabi ko kanina na the entry to recognize deferred tax liability or deferred tax asset is dependent upon the movement of the account during the period. So always consider if there is an beginning balance. So since the deferred tax liability account increased, so we credit the deferred tax liability. Now, for the deferred tax asset account, from 525, it decreased to 450,000. So our entry would be to credit the deferred tax asset account by 75,000 and debit income tax expense deferred by 75,000. Actually, this is an example of the reversal of the deferred tax asset account. Okay? So to summarize our discussion for this topic, So let us have again this reconciliation. So accounting profit, we omit the effects of our permanent differences. We'll arrive at our accounting profit subject to tax, and we omit the effects of the future temporary differences. Our taxable temporary difference and deductible temporary difference will get taxable profit. And then accounting profit is determined by applying IFRS, whereas from non-taxable revenue to taxable profit, we apply NIRC. Okay? So again, thank you and good luck.